Good morning. Welcome to Trading Hour. I am Reema Tendulkar with Mia Pavitra Parekh and Surbhi Upadhyay. Girls, it's a curtailed week, but a very important one, right? In the run-up to the earnings season, we've got the RBI monetary policy, banking updates have started, kicking in. And look at the way crude prices have risen overnight. So oil is on the boil. Brent crude prices are now closer to that $84 per barrel. And is that something which is capping the gains in the Indian markets? The Indian markets were in a fairly good rhythm over the last couple of days. Last week, we had broken out of that trading range. Friday was a solid session for our markets. But today, things are fairly quiet at the index level. The Nifty is absolutely flat. An important level to track will be the 200-day moving average on the Nifty, which is closer to that 17,500 mark. Broader markets are doing pretty well. Look at the small cap index. The BSE small cap index is a gain of nearly 1%, and the advanced decline ratio, 4 stocks in the green for 1 in the red. So even as at the index level, things are capped and absolutely flat, the activity continues in the broader markets outside of, these large caps. In terms of the sectoral moves, autos, the numbers coming in terms of the March auto sales have been fairly robust, particularly two-wheeler names. TVS, Hero MotoCorp, Maruti Suzuki exceeded expectations, and the Nifty auto index is up 1.5%. On the flip side, IT is having a bit of a backseat today. The Nifty IT index is down 0.7%, and the star from Friday, Reliance Industries, has come in for a bit of profit taking. So that's down close to about 0.5%. So no follow through, at least on Reliance Industries so far this morning.
Actually, or on the market move as well, right, Reema? Because Friday seemed to be a very decisive day. And the bulls would have loved to see a bit of an add-on to it.
Follow through.
But we're not getting that. We're not getting it in global markets either, or at least Asian markets, because we woke up, Asia literally woke up to that headline that you mentioned on oil prices suddenly surging, OPEC deciding to slash output. That was completely out of the textbook. In fact, I just want to start with that. Let's see if we can pull up the oil levels right now. Still up by 4.5 to 5% odd. There you go. Near 5% gain on Brent, 83, NYMEX at 79. There are reports that are calling already for $95 a barrel, $100 a barrel on crude. So the markets had to digest this, and that's playing out. Let's take this to stocks then. The reason why you're seeing that surge on ONGC and a stock like Oil India is because they are the upstream beneficiaries. So this is where the news is good. But then let's move to the rest of the gas space, where there's a completely different dynamic at play. There you go. MGL, IGL, Gujarat Gas, pretty sharp cuts on these stocks. Now you would wonder why. And that is because the market had an expectation that come the 1st of April, we would be in a new gas pricing regime with the Kirit Parikh report getting implemented. However, that has not yet happened. We'll in fact talk more about it. We spoke to the man himself, Mr. Kirit Parikh, to understand how he's looking at the developments and the timelines in terms of implementation of that report. But that disappointment essentially is what's playing out on the stocks. GAIL is very, very flat. For GAIL, at least the tariff revision has come in. So that's one policy uncertainty that's out of the way. And then, of course, we need to see how the Kirit Parikh report gets implemented. GAIL right now is down about 1% the last time I checked. So those are some of the gas stocks and oil and gas stocks, actually, that are really hitting the headlines. Pavitra, what are you tracking?
Oh, absolutely. But I think the other space is auto sales, right? We got so many of them coming through. So pretty much that entire space is buzzing around, and most of them are doing quite well. So take a look at the larger Nifty names. You will see most of them are from the auto pack. So whether it's an Eicher, Hero, Maruti, it's not a great set of numbers, but better than what we were expecting, right, for a lot of them. So Maruti has actually clocked in its best performance in terms of sales for the full year, 20% growth in the domestic market, so a lot better than what was expected. Take a look at some of the smaller auto names. SML Isuzu is up 14% right now. You have big moves coming in on some of the others as well. Atul Auto up 10%. Lumax Autotech up around 3% over there. So this entire space is definitely in focus. On the downside, it is really the IT stocks which are seeing cuts today. The larger names, of course, but a lot of the smaller IT names as well. So the likes of Persistent, KPIT Tech. KPIT Tech, of course, has run up a lot, but there's a recent note also by JP Morgan. I think on the back of that, this one has slipped, but a few of the mid-cap IT names in focus on the downside. And in terms of cues, like Reema was mentioning, it is really the RBI policy, which is on Thursday. That is key to track. We have crude prices, which have seen a big rally. So how do they move? A lot of the Q4 business updates coming in ahead of the earnings season. So right now we have lots from the likes of CSB, Karnataka, which are in focus. So, these are some things that we would keep an eye out on. The rest of the auto earnings will also come through. So that's what we're tracking as far as the market goes. But with that, let's bring you more on the gas story that we were just mentioning. Gas stocks MGL and IGL correct after the government keeps APM gas prices unchanged till further orders. The street was expecting Kirit Parikh's committee recommendations of price hikes to be accepted by the 1st of April. Now, the panel recommendations they had earlier said is 4 to 6.5 MMBTU gas price band. This is for gas from oil fields, and the removal of caps on gas prices in 3 years. It also says that city gas distributors as well as fertilizer sector should hold top priority for allocation in the intermediate period. We were earlier speaking with Kirit Parikh, the gas committee chairman, and here is what he had to say on this. Listen in.
I've heard from people that yes, the cabinet is considering it. It's likely to be approved. But when it will be is anybody's guess. We have said that by 1st January 2027, everything should be market determined. I'm quite hopeful that it will be accepted.
Okay, the other big talking point is crude. Crude prices have rallied 5% and now hovering closer to $84 per barrel after OPEC plus oil producers have announced a surprise production cut of more than 1 million barrels per day. We also had a chat with David Lennox, analyst at Fat Profits, regarding this development and where crude prices are headed from here on. Here is what he had to say.
We would expect to see Brent trading in the near term probably up at $85, probably not much above that. So overall, we're looking at this point in time in the short term up to between $85 and $87, but perhaps longer term we could see the oil prices actually weaken, and we wouldn't be too surprised if we saw it between $70 and $80. It's difficult to determine if there's any political scenario in what OPEC have done. We would suggest that the only benefit that they've gained is that they've probably knocked US shale production for 6, and they don't expect to see that production coming back on stream. Of course, as they raise prices, if they cut production further, that could change. But I think they're very comfortable that they now control the markets again, and probably from that perspective, that's really all that they were looking for.
All right, that was a word on oil prices. We'll revisit that story in a bit. Right now, shifting the focus to the defense space. The Ministry of Defense has recently approved several orders for stocks like BEL, Bharat Dynamics and Garden Reach. Vivek is here with the roundup. Vivek, typically it's that last period of the fiscal which has a lot of bunched up orders coming in, right? So how's the picture looking this time?
Well, absolutely. Entire FY23, if you had to look at the defense space, one particular space that was typically abuzz on the back of swelling order books, mainly on the back of the fact that the indigenization, the Make in India and the Atmanirbhar Bharat, being the key buzzwords as far as the entire space is concerned. But now, all of those words are being translated into actual, booking as far as number one, revenue, order inflow, and swelling order books are concerned for the entire defense space. So, what's actually happened is that for FY23, you actually have had 3 companies that have come up and given their revenue as well as order book updates. So, first on the list, Bharat Electronics, very strong update. Revenues up almost 15% on a year-on-year for FY23. Order book is at 60,500 crore and FY23 order inflow at 20,200 crore, largely in line with what the street was anticipating. HAL, revenues up almost 8% on a year-on-year basis. Order book at 82,000 crore and order inflow for FY23 coming in at 26,000 crore. A slight disappointment there, but largely on the back of the fact that these order bookings are quite lumpy in nature. GRSE, Garden Reach Shipbuilders, revenues up 45% on a year-on-year basis, and also some news flow coming in from BHL in terms of large order flows that have come in. ICICI Securities has actually written a detailed note, especially taking into account that the Ministry of Defense has placed orders over 44,240 crore just in the last week of FY23, and on the back of that, they are quite positive on the entire PSU utility space as far as the defense spaces are concerned. Their top picks are BEL. They've gone ahead and upgraded Bharat Dynamics to a buy from an ad that they had earlier, and Garden Reach, they are quite negative at this point of time. They continue to have a negative or a reduced rating on the stock.
Very much for that. In fact, on that note, let's welcome Amit Dixit of ICICI Securities on the show to take a few questions. Amit, morning, and thanks so much for joining in. Orders galore, right, for the defense companies in the last 1 week itself. We've seen orders worth 44,000 crore and plus. Can you tell us the total order wins in FY23, if you have that number? How does it compare with the last couple of years and the individual order books of all these PSU companies?
Yeah, hi. Thanks for having me here. So, if you look at the order book, there was a concern on the street that order accretion might not be substantial this year, given that in case of Bharat Electronics, for instance, the order book for last 2 quarters was at like the lowest level in past 2 years. So, if you compare on back of that, the order accretion that has happened in the last week of the year has been substantial. And when I say substantial, the orders that have come in are, again, in defense, for example, in HAL, there was a substantial order when the Tejas was on the anvil. But then, you have typically periods when things might not be that chunky. However, as against the expectations, I would say that Bharat Electronics completely ticks all the boxes. 15% revenue growth, just what management guided, and the order inflow of above 20,000 crores. Now, this is not all. If you look at it going ahead, what we believe that if you look at BDL's order, for example, for the 3rd and 4th Regiment of Akash, Bharat Electronics will have definitely a finger in the pie. Now, going ahead, even if you look at the naval orders, so there also, Bharat Electronics will definitely have a role to play. So that's why we consider Bharat Electronics at a real sweet spot at this point in time. And given the fact where the price is, we believe that there is a good 30% upside in the stock from this level.
Okay. So that's about BEL, 30% upside. The share, the company is placed in a sweet spot. But just to get some numbers in, Amit, for the full year, what has been the overall order inflows that have been handed out by the Ministry of Defense? And how does it compare? Are we really seeing a step up in defense orders?
Yeah, certainly. So if you see the capital procurement, ever since FY18, if you compare it from last year, compare it from FY18, you will see that the capital procurement year over year has gone up, and this year being no exception. Now, what we were slightly concerned before these orders came in, that if you look at the FY23, the budgeted numbers versus the expenditure that had been done till December 22, there was a wide gap as far as the Air Force and the Navy are concerned. So, in fact, the utilization of budget for Navy and Air Force was to the tune of just 50 to 55%. Now, with these orders coming in, I believe that for Air Force, we still believe that the complete utilization has not been there. But for Navy and for Army in particular, I think they will cross the line. So clearly the orders have been higher, except in case of Air Force.
Okay, Amit, got that. Let's talk about your other pick as well. I think you like Bharat Dynamics, and what a journey for the stock, right? I was just tracing 1 year movement. It was at about 550 to today. That stock is sitting at 970. So you like it despite the huge price run up? What are the triggers here?
Yeah, so Ravi, so if you look at Bharat Dynamics, last couple of years have been a little bit on the slower side because people were expecting this Akash 3rd and 4th regiment to flow in. Now that has finally happened. So I would say a big overhang on the stock is gone. Going ahead, what we believe that in fact the QRSAM testing happened in the beginning of the year. So that order should flow in around 2 years of time, and that is a substantial order around 14,000 odd crores. Now, in more immediate terms, we would think that MRSAM for Navy should flow in. So clearly now the orders will start flowing in. So if you look at 6 months down the line, Bharat Dynamics would be a different story from what it is now. You will have more clarity on MRSAM. You will have more clarity on MRSAM for Army. I was talking about Navy earlier. You will have more clarity for Army. QRSAM, you will have more clarity on. Apart from the fact that they are also developing their new facilities, and particularly the development that is happening in Jhansi along defense corridor. I think these are something that are very substantial for the stock. So if you look at the stock performance, I mean, we believe that in case of revenue, the 3,200 crores revenue they will book this year. Next year it will be around 3,800, no doubt about that. And going ahead, we see that that considering that big chunky orders, QRSAM, MRSAM, they are in pipeline. So the order book and the realization can only go up from there.
Okay, got that. Amit, thanks for joining us. On Hindustan Aeronautics, can you tell us if you have any, view on this after the stake sale? And in general, for a lot of these, PSU stocks, there's that constant overhang, right, of a stake sale, of an OFS. Do you think that hits the valuations that are attributed to these?
Yeah, so Hindustan Aeronautics, I mean, if you look at the stock, that's kind of an evergreen stock. And in fact, the OFS was a trigger for people to get it. Now, for Hindustan Aeronautics, so specifically, we believe that in the near term, we see very limited triggers. The reason being that next 2 years, I think, would be probably on, repairs and overhaul. This kind of revenue would be booked into the extent of 40%. Manufacturing would be a tad lower. They will be completing whatever are on annual. I think the biggest trigger for Hindustan Aeronautics is the development around Mark 1A and the news flow around Mark 2. I think that is something that is to be looked at next for the stock. So given the fact that a lot of things are kind of placed in the stock, we would think that it will consolidate at this level until more clarity emerges on Mark 1A and Mark 2.
Very quickly, Amit, you said in Q2 and Q3, the street was disappointed because the order inflows, the order book numbers were disappointing. But considering that we've seen a slew of orders in the month of March, will Q4 positively surprise? What are you baking in terms of Q4 expectations from these companies?
No, so, in defense, first of all, unlike many of the sectors, one should not look at quarter on quarter. But given the fact that, in Q4, for instance, when Bharat Electronics Management said that we will get an order inflow of roughly 15,500 crores, I mean, and we were sitting in February, mid of February. I mean, a lot of people thought that it was impossible, and therefore that is also depicted in the stock movement. The stock didn't move anything from there. But now, given the fact they have achieved their guidance, I believe all is well that ends well. So this year has ended well for them. Next year, I guess, with the pace picking up on Bharat Dynamics order, that is Akash 3rd and 4th Regiment. So I believe in terms of next year, they're already sitting very nicely on order inflow of roughly 8,000 to 9,000 crores from Akash 3rd and 4th Regiment and the trickle-down effect of naval orders. So that's why we are quite positive on Bharat Electronics.
Okay, so that is a slew of defense-related stocks that Amit likes. Thanks very much. A good conversation as always. Thank you for joining in, and we look forward to the next one. Let's take a very quick break on that note. On the other side, we get back to commodities. Oil has been making headlines, but there's also a lot moving in gold. Manisha Gupta will join in. Welcome back. You're with us on Trading Hour, and we're talking commodities now. As we mentioned, crude, of course, is the big headline with this key surge coming in with the OPEC Plus surprise cut. But right now we have Manisha talking about gold. Manisha, enough of crude since morning?
Well, yes, and crude continues to hold there. Actually, when we started the day today, we saw crude prices jump up by nearly 7%. We are still 4.5% on the higher side. But while the crude prices have started April on a very good note, 5% up, the month of March was 7% down. The quarter was 9% in the negative for the crude oil prices. But one thing that it's done extremely well in the last couple of quarters and for the month of March and has started April all right is the gold prices. We are trading at around 1 month highs onto this one. We've seen gold prices gain up by 8% for the month of March, 9% for the March quarter, and plus 9% for the December quarter as well. So in last 2 quarters, we've seen gold prices gain up by 18%, and this has never ever happened, is the reason I'm putting it on table for you here. The gold prices also have broken above $2,000 per ounce 6 times in the month of March, and most analysts believe that this is going to be a stiff resistance for this one, because every time we cross above $2,000 $60,000 per ounce for gold, we see some profit taking coming in, and that's exactly how we're dealing with it right now as well. But the gold prices are holding on the back of also sense that there is a 40% probability that you might see the Federal Bank hold rates, perhaps pause for the month of May. There's a 60% chance that they may do that, but this is a good probability, as is what the money managers are looking at as well. And when you look at the money managers' net longs as well, it has been on the positive side for an 8th straight month in the month of March, and that has been supportive as well. So while there is good gains in gold, I also want to touch base on natural gas, because the major underperformance clearly has come in for this commodity. We have seen natural gas prices start the month of April on a positive note, but we have seen the prices decline by 19% in March, down 50% in the previous quarter. Of course, we've all been talking about above normal temperatures, higher inventories, and that has continued to weigh onto this commodity as well.
Okay, thank you very much for that, Manisha. Get into a break. On the other side, we'll be joined by the management of Avalon Technology. Stay tuned. Welcome back. Let's turn our attention now to the primary market. Avalon Technologies IPO opens today. The overall issue size is 865 crore rupees. And to understand more about the company, what it does, how the valuations stack up versus peers, and what its growth rates look like, Surbhi is joining in with the details. Surbhi.
Thanks for that. That's right. Avalon Technologies issue is all set to open today. The issue size is 865 crores, of which 320 crores is the fresh issue and 545 crores is the offer for sale. Now, the price band is in the range of 415 to 436 rupees per share, which gets an implied market cap of 2847 crores. The company is going to use the proceeds to reduce its debt by 145 crores and fund working capital requirements to the tune of 90 crores. Post the offer for sale, the promoter stake in the company will reduce to 51% from 71% currently. Now, a little bit about the company. It is an integrated electronic manufacturing company which focuses on high-value precision products. The company has 12 manufacturing facilities, with 2 in USA and 10 in India. The company provides a full-stack product and solution suite, from printed circuit board design and assembly to end-to-end box build of electronic systems. It services multiple end-user industries, with close to 60% of their revenues coming from 3 main industries: clean energy, mobility, and industrials. In the 8 months of FY23, which is till November 30th, 2022, it did a revenue of 585 crores with an EBITDA margin of 12% and a PAT margin of 6%. The company can be compared to other similar solutions provider companies like Dixon Tech and Amber Enterprises, and also recently listed Keynes Technology and SGS Sigma Technology. Now, these companies trade anywhere between 50 to 100 times FY22 PE, and Avalon Technologies is also valued competitively at 59 times FY22 PE.
Thank you very much for that. We're now joined by Kun Ahmed Bichad, the chairman and MD, and Mr. R.M. Subramaniam, the CFO of the company, on the show now. Thank you very much for joining in, gentlemen. Mr. Bichad, my first question is just to understand the business model and the margins of the company versus peers. I understand that, you all are operating more in clean mobility, while companies like Dixon Technology, which are also electronic manufacturing companies of components, etc., and they cater more to ACs, but there is a big difference in margins. Their margins are much lower versus yours. Yours are, in double digits. Can you first explain, why this disparity in margins? How were you able to command higher margins, and what's the outlook on margins from here on?
Thank you. Thank you for having us. We believe we focus on industries which drive margins. So where we do a lot of mission critical stuff. We do end box builds because we do our own PCB. We're not really a PCB assembly shop. We do our own metal. We do our own cable, our own plastics. So when we integrate all these different parts from our different factories to build final products, our margins usually is on the better side, in the low teens as of now, and could go better into the future. And saying that, we're not into consumer electronics as much. We do products like railway signaling. We do parts inside the planes, seating and lighting. We do parts in aircraft engines. We do our existing products today are into different type of solar, like inverters, converters, trackers. We are into making parts of hydrogen electrolyzers. So these are critical pieces which drive the margins up because it's not something which can be repeated easily.
You said there is scope for margins to improve from here on. What will drive that?
It's primarily the leverage on our capacity. We operate around 60 to 65% of our capacity today. So we have enough capacities internally for the midterm. So once you start leveraging the capacities, I think the margins should be marginally higher.
Okay. Mr. Subramaniam, I believe that, obviously there's part of the issue is an offer for sale. The other, you are retiring debt and also you need the funds for your working capital requirements. So can you tell us about the money that's coming in the company? When you retire this debt, what will your debt equity ratio come down to? And what is a typical working capital cycle for you like?
The rationale for IPO, we are seeing a significant growth momentum, which is for the whole industry and Avalon in particular. We want to make sure this growth is fully funded. We've been growing at 10 to 15%, let's say. We are a profitable company and we can continue to fund ourselves. We don't need external funding. But the kind of growth momentum, what we are seeing, we want to make sure the growth is fully funded, and that's the reason we are raising money for the primary and then the company. The primary purpose of that is, of course, debt reduction. 50% of the debt will go down and correspondingly the interest cost should go down. And over and above that, we should be generating free cash flow, which should also get the debt down. So that's the primary idea, to make sure the debt goes down and our balance sheet gets strengthened, and probably a debt equity should go to 1:1. And we have the capacity to re-leverage back as we go along. So that's the idea. We are covered for the next 3 years in terms of the funding requirement. And the key purposes are our business model is we are a capital light model and we'll continue to remain that way. Going on to the next question in terms of working capital, we are a working capital intensive business. So to that extent, we are about, the steady state is about 60 to 90 days of working capital, net working capital in terms of sales. Today is about 120 days. And we believe as we go along, the component shortage should ease out and then it should come back to normal. Okay. This is an industry-wide phenomenon and we are exposed to that as well. But moving forward, we should return back to normal.
Yeah, I mean, I'm just asking that because a colleague was telling us that for some of your peers, for instance, for Amber, it's a 19-day cycle. A couple of the other companies ranges between 20 to about maybe 40 days. So your working capital, I believe 9 months is about 352 crores. It's been progressively increasing quite a bit over the last couple of years. Can you give us some idea of by when you will normalize it down, second quarter, third quarter, fourth quarter, how many working days, and what should be the working capital requirement once you reach this target?
So as MD said, in terms of our business is more a B2B. So technically it's not a good comparison to do a B2C comparison. Okay, B2B is what we should look at. And in B2B, there is still some amount of component shortage, which has led to the inventory increase. But we are seeing the early signs. The good news is that we are seeing the early signs of component shortage easing out. And as we said, about 12 to 18 months, we should see returning back to normal, where the net working capital cycle will be about 60 to 90 days. And that's what has been a steady state. Pre-COVID, we've been operating at that level, and we believe we should be able to go back to that moving forward as well.
Okay, got that. Gentlemen, good morning and thanks for joining us. This is Pavitra. Mr. Bicha, if I can come to you, I was looking at your revenue contribution. It is pretty, concentrated at the top, but it has come down a lot. So in FY22, from your top 2 customers, you got around 26% of revenue. In the 8 months of FY23, it's at 18%. So can you tell us what's going on there? Are there some, perhaps some large orders which are coming to an end?
So that's actually good news for us. So instead of being top heavy, what we're seeing is some large customers come in and their production has started, so that it's getting evened out. So we're going to start tracking this by top 2 customers by industry. So it's more of an evening out with new customers coming in and some of the existing customers going to the top side.
Mr. Subramaniam, you said that with the amount that you raised via the IPO right now, you'll bring down your debt by 50%. What's the outlook on bringing it down completely? Do you have any target in mind?
I think overall, suffice to say that today the debt will reach about 50 to 75% of what is today. Okay, and we will maintain, even today it's about a 300 crores net debt, out of which 230 crores is working capital or short-term debt. We should bring it down, but we'll maintain our lines and then make sure that these lines are available for us to re-leverage back as the growth momentum picks up, in which we are seeing the early signs of that, or the signs of that in terms of more customer visits, etc. That's the primary purpose of the fundraise, to make sure we use this, I won't call once in a lifetime, a very important lifetime and an inflection point for the industry in Avalon in particular, that we use this as a pivot to grow into the next orbit. That's the purpose of what we're doing now.
Okay, got that. Just a word on, I'm going back to the point. I think you mentioned, Mr. Bicha mentioned that you're operating at 60 to 65% capacity utilization. Isn't that on the lower side? Where was it, let's say, pre-pandemic, and where do you see it going up to? And then a related question, also noticing that the contribution from your top customers has been coming down. It's not just top 2 customers, in which you can sort of say that maybe you're widening the customer base. Even if I look at top 5, top 10, the aggregate contribution is coming down. Why is that?
In terms of, I think the widening of the customer base is the key point. And number 2 is we are having clean energy as an important sector, which is contributing in a big way. And many of the customers are just, got introduced, and they are ramping up. So this is the overall impact of overall customer base going down. The other part to note is about, even within the top customer base, each of them is in a different sector. So Avalon as a company is fully diversified, and that's how we've been able to ride the COVID disruption in spite of COVID or component shortage. Because we are fully diversified, we've been able to manage without any disruption, continue to grow profitably during this sector, or during this period. This is again a byproduct of what we've been diversified, and will continue to remain so in terms of moving forward as well.
All right, we got that. Gentlemen, we're going to leave it there today, but all the best with the listing, and we do hope to speak to you very soon so that we can get some more details in terms of, your guidance going forward and what the order execution timeline is also looking like. Thank you for joining us today. That is the management of Avalon Tech telling us about, their plans with the IPO money that is going to come in, and they are looking to list very, very soon. But with that, we do need to get into a short break. By the way, a quick look at the market, because we have seen a slip. We're down around 35 points right now. The Nifty Bank has also moved into the red. So we'll do one thing. We'll take a quick break and come back, and then we're going to discuss the market technicals. Kush Bora will be with us.
इंसान को हमेशा अपने ऊपर ध्यान देना चाहिए. कैसे?
Welcome back. You're still tuned into Trading Hour. We are at the low point of the day for the market right now, around just slightly off the lows right now, but it's 25 points lower on the Nifty. A lot of the oil marketing companies seeing some cuts. So BPCL is down around 3% right now. You have the rest of the pack also that we were mentioning, and a lot of the big tech names are only seeing losses, just increased right now. So you have Infosys, Tech Mahindra, TCS, which are seeing pretty significant cuts right now. But let's get you a check on the market. Kush Bora joins us. Kush, take us through how you look at this. I mean, we opened a lot better than what was expected as well, right? A lot better than what the SGX was indicating, but we have come off significantly from that level. How do you expect the rest of the session to pan out? I mean, it is a very short trading week, but how do you look at this now?
Well, that's in some ways good news for us, right? We've been wanting some holidays after the kind of volatility we've seen. So, Pavitra, first up, thank you for having me on the show. Well, I'm not surprised. See, we rose too high, too fast in the last couple of sessions, and 17,400 call on the Nifty and 40,700, on the Bank Nifty, which is also the upper band of its downward sloping channel, which started in December. So these are a couple of technical points which are acting as, a resistance zone on the Nifty and the Bank Nifty. But, dare I say, the kind of, move that we've seen in a lot of large cap names and the indices, thereafter, I think the room has opened up for 17,800 on the Nifty and 42,000 on the Bank Nifty. So for me, any kind of dips, in the indices, in the, large cap names would be an opportunity to buy. 17,400 might act as an immediate resistance, as I said, only for this expiry, which is actually just 2 days away given the holiday. And 17,200 is where I see the support. 41,100 is an immediate resistance on the Bank Nifty, and 40,300 is where I see the support. But as I said, on the dips, I would be, a buyer in these markets.
Okay. All right, so you'll be a buyer of the dips. That's index level. What about individual stocks? What are you looking to pick?
So there'll be plenty of action, especially in the mid cap and the small cap space. So I've got two picks, from that space in the markets. First is Tejas Networks. The stock was actually showing a lot of strength, in the last couple of sessions as well. But today, given the kind of support that we've seen in the market over the couple of days, it's broken out and it's trading above all its key averages. So this is given a very clear breakout. I expect this momentum to continue for much longer. But from a trading perspective, 640 would be my immediate target, 600 would be my stop loss. The second one is from the banking space. Federal Bank, again, very similar story. The stock has been doing well, but was under pressure given the market situation. Today, we are seeing a follow-up. In fact, it's the third day of a follow-up buying on the Federal Bank stock. And this is also trading above, most of its key averages. In fact, 130, 133 was a key resistance zone. And the stocks held on above those levels. So my suggestion here would be 137 looks like an immediate target. 132 is where I would place my stop loss.
Thank you very much for that, Kush. Get into a break. On the other side, we'll discuss market fundamentals. We'll invite Rakshit Ranjan from Marcellus Investment Managers on the other side.
Welcome back. The market continues to be more flat than either up or down. Good time to bring in Rakshit Ranjan, portfolio manager at Marcellus Investment Managers, to discuss the outlook going ahead. Rakshit, good to have you on the show and good to talk to you after a gap. So we have been in an interesting market, right? So much news flow in the last 3 months and a fair amount of price correction as well. You tell us, how do you look at the broad framework right now? Because we're getting into the litmus test period, right? It's corporate earnings season. And that's where we have been seeing a series of downgrades even in the last few quarters. So what's the thought process with which you're approaching the portfolios now?
Yeah, good morning. And thanks for having me on the show. I think the corporate earnings season this time round is very different from the last 3 to 4 quarters. Broadly speaking, there are 3 sources of noise which existed in the last 3-4 quarters, which seem to be now fading away. The first source was with COVID-related lockdowns or COVID-related business coming to certain companies. There was a lot of sort of noise in the comparables. Either companies were shut because of lockdowns and hence the comparables weren't normal. They were aberrations, or they were getting some COVID-related business, which obviously was not sustainable. The second type of noise was after the Russia-Ukraine war, commodity producers, they saw a massive benefit in the reported fundamentals, and the commodity consumers, they saw an adverse impact on margins, right? And that as well is a factor which I think from particularly 1Q FY24, partly from 4Q FY23, that factor will also start showing signs of fading away, certainly in the commentary of the management teams. And the third bit was FY22 in particular was a year where many companies, they latched on to the opportunity to accelerate their capex, their investments in various areas in order to benefit from the crisis, from the COVID crisis. And those capex investments, whether it be around tech, around a new acquisition, or adding new revenue growth drivers to your business, those kinds of investments have started to yield results or will start to yield results, and positive or negative outcomes on those will define the corporate earnings. So it'll be a lot more comparable, particularly from 1Q FY24 onwards, and commentary especially from 4Q FY23, which should sort of start separating the men from the boys in a much better way than it had in the last 3 to 4 quarters, the way we see it.
Rakshit, morning. Rima here, particularly on Bajaj Finance. And this has been a favorite of Marcellus Investment Managers for a while now. I know in the past when the stock had dipped considerably during COVID, you all had gone ahead and lapped it up as well. Well, there is a possibility of a big disruption in the space with Jio Financial Services planning, to go for an IPO. Do you see the business model getting hurt for Bajaj Finance?
Right. So to begin with, there are 2 or 3 data points which are actually very attractive for an investor when you look at Bajaj Finance. One is that this is a company which is not 30, 40, 50% of the market share in the lending space. This is only 2-3% market share. So they're far more weaker competitors to gain share from rather than worry about any new entrant. And new entrants have kept coming here. Certainly, the new entrant you're talking about, they will have a massive benefit on the capital availability side, liability side, given their parentage, etc. But I don't think that means that a 2%, 3% market share controller in the lending space is the target only. Secondly, I think Bajaj Finance as a business has transformed quite meaningfully and quite positively the way we see it. If you look at the fee income contribution to their profits, it's significant. So a simple statistic there. 2/3 of Bajaj Finance's loan disbursement in a year comes from existing cross-sell, upsell customers, right? Existing customer base. That existing customer base has had only a 3% AUM CAGR per customer over the last 5-6 years, but a 14%, 14% profit after tax CAGR, right? So it's a fintech company being transitioned away from just being a lender. And hence, there are many strengths getting added to the business, which keeps us excited. And typically, higher the quality of the company, it manages competitive intensity in a much better way. This is not that Bajaj Finance had a good run in the last 10 years because of weak competition. That's not the case here. So yeah, we look forward to how they respond to competition, but at the point in time, at this point, we are quite convinced, and as you rightly said, it's part of many of our portfolios.
Okay, Rakshit, good morning. We were just talking about how the markets have corrected significantly in the past few months. Have you identified any new ideas in this time where valuations perhaps after this correction now look more reasonable and you would look to add? Is there any kind of new idea that you've identified?
Yeah, no, in our smaller cap portfolios, there are a few ideas that are getting added. Some of our existing portfolio companies, so for instance, Divi's Lab is a company in our large cap portfolio, CCP. The crash in the share price and the attractiveness as a result, incremental attractiveness compared to where it was a year ago, has meant that we've actually added Divi's in one of our other portfolios as well now. So there are new ideas which we are working on, but more importantly, a lot of the work on existing ideas has become far more attractive given the valuations. You're right, and hence we are rebalancing and changing our portfolio constructs there.
Rakshit, speaking of the portfolio construct, you still do have Dr. Lal Path Labs in one of the funds, right? Yeah.
Yes, in many funds, yes.
In many of your funds. So let me ask you this. Everybody's getting the flu, but the thing is that not too many people are testing. We had Ameera Shah of Metropolis actually on the channel a couple of days back, who also kind of was pointing in the same direction, that there is a lot of competition and price cutting in the B2B segment. On the other hand, at the retail level, even with the flu cases going up or some COVID cases, RT-PCR testing is not exactly picking up. So what's the thesis here, given the huge price correction we have seen in these diagnostic stocks?
Yeah, the thesis is not about seasonality pieces or sort of short-term oriented pieces, because for a business like this, there'll always be a year where dengue outbreak was far greater than the previous 3-5 years. There'll be a year where swine flu and bird flu and COVID, and there'll be many other, and there'll be a healthy year in terms of health of the customers, and hence low footfalls for certain types of tests, so on and so forth. Those are fluctuations which this business will always have. Every year will be different from the last year around certain disease. But that's not the thesis basis which we buy companies. Our thesis here is that the space is huge. It's a diagnostic industries, 90,000 to 1 lakh crore in size. Within that, pathology is at least half of it. Out of that half of the pathology industry, mom and pop labs and government labs together, they control more than 80-85% of the rest. And hence, there's barely 10,000 odd crores, which is in the control of pan-India chains. Now, pan-India chains, they offer massive value add compared to compared to the mom and pop labs or some of the government operated labs. And that is where, to begin with, there is a massive market share shift opportunity which is being capitalized on from non-Pan India chains towards Pan India chains. Amongst the Pan India chains, then we see not too many companies strengthening their long-term oriented competitive advantages. For instance, for somebody like a Dr. Lal Path Labs, we see this firm being very differently positioned today versus 3 or 4 years ago around the way they use technology to do not just D2C, which they had left completely open, and hence many of the private equity funded players actually entered, but also B2B for somebody like a Dr. Lal is happening via a lot more tech-oriented solutions provided to hospitals, which helps the hospital do their job better, etc. So this is no more just a sort of cutthroat competition on pricing related B2B industry, and the strengths are far more around hub and spoke management of the retail execution that we see for a business like Dr. Lal.
Raksha, thank you very much for joining in. So it's a play on the formalization of the diagnostic space and an increase in market share of these larger pan-India companies. Thank you very much for joining in. Get into a break. We'll come back with more on the markets.
Welcome back. For the market, it's absolutely flat, just around 20 points in the red right now. So no big move really coming through. There's a little bit of an attempt higher once again. But, what's encouraging, like we were telling you, is that the mid-cap and small-cap side of things looks a lot better. Mid-cap index up around 0.3%, and the small caps are holding up with an even better gain. So that's the shape of the market right now. But we are going to wind down on that note. You stay tuned because halftime report comes up next to take all of this action forward.